The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Oh, happy Wednesday, everybody. Welcome to Squawkbox Europe. I'm Steve Sedgwick with Karen Cho, and these are your headlines. The chips are down. I'll see what they did there. U.S. memory and AI names tank as a global tech sell-off continues. Traders reassessing their stance, for now at least, on the AI boom, with attention focusing on Micron when it delivers its results today.
President Trump targets big oil with claims of price gouging, while shipping traffic through the strait returns to its highest level since the start of the war. And Secretary of State Marco Rubio arrives in the UAE looking to ease regional concerns. 3 times the charm, Bank of America eyes a triple hike from the Fed this year, upending its previous base case of no change in 2026, saying the central bank's inflation problem is unambiguously worse. Well, there is no doubt we are getting a roller coaster ride in some quarters of the market. Not all of it. If you look at the major indices and where they finished up yesterday, it looks like in some parts fairly calm activity. The Dow, for instance, barely moving from that flat line, only slightly in negative territory. But where the pain was felt yesterday, very much concentrated around the Nasdaq, and areas of the Nasdaq that until very recently in session yesterday had been actually on a very strong run higher, namely the chip stocks. And finally, some of the rout catching up with these names spilling across from the Asian markets across to the United States. You could see it on the Nasdaq, that pullback, but also the Philadelphia Semiconductor Index. It is a story we're going to be talking about a lot, and it's leverage that is now kicking in. Leverage from that South Korean market across in Asia that is now spilling across to the US markets as well. The Semiconductor Index down 7.8%. Is it healthy? You could argue yes, after what has been a very strong run. This is an index that has claimed about 6,000 points to the upside since the start of the year. Don't forget it was trading just over the 7,000 point level as it kicked off the trade at the start of 2026. But the very bumpy activity you're now seeing on a daily basis to the upside and a daily basis now to the downside is a sign of instability potentially. Let's get into some of those actual chip stocks. We're going to get more information later on today. That is Micron, very much attached to the fortunes of SK Hynix over in South Korea, and also Samsung. So there's a real feedback loop now between some of these big names. What Micron guides later today could be significant for that activity too. What you're seeing on the back of those big falls in the chip stocks, let's take you to the Asian markets to see how those key markets of South Korea and Japan are traveling. Well, the Kospi has snapped back, so we've got a bounce there about 3.5%. So it is a day again to the upside, and you've got to say strong moves again. The Japanese stock market that is down 0.7, and across the rest of the region, Hong Kong, the Shanghai Composite, much smaller ranges, but in firmer territory. Now, I want to talk about some of those catalysts for South Korea. Samsung this time. And don't forget, there are just 2 stocks mainly driving that market as Samsung and SK Hynix. Now, Samsung shares are surging in South Korea, recouping most of Tuesday's 12% loss. The turnaround has helped the Kospi bounce into the green. It comes as Samsung will reportedly launch a $59 billion share buyback program following an agreement with union leaders in recent wage negotiations. That's according to Yonhap. SK Hynix and Samsung both led those losses in Tuesday's trade, falling more than 12% and triggering a trading halt in the afternoon. Earlier in the week, the head of the country's market watchdog acknowledged it had been too quick in approving leveraged funds tied to high-profile chip stocks. And that is quite key, that comment from the regulator, because it does feel as though leverage is now causing a lot of forced selling, not just normal selling, but forced selling in some of those downbeat days. To the European markets in the close we saw yesterday, it was negative across the board in the face of a wave of selling across on global markets. We were down 0.75% on the benchmark, the stock 600. A little bit less coming off the FTSE 100, much more contained, as you can see. Steeper falls felt on the Italian stock market. To the European chip makers, part of that mix, this is how they looked, and you can see it was a tale of selling there as well. Very high single digits mostly across the board. So it really is a global story when we talk about some of these chip stocks. To the European futures, as we look to get going this morning, the signals that this is what it's telling us. Again, looking very cautious at this hour on the 50 futures here in Europe, across to the DAX futures. FTSE is seen down a little bit more, about 1/3%, Steve.
Yeah, Karen, come back and join me. I'll just mention this Micron story you alluded to as well, and it's the next big benchmark as well. But we have gone a little bit crazy this year on what is a very commoditized product, i.e. memory chips as well. And I know we talk about the market move, but I just want to put this in context. Less than a year ago, okay, I'll go back 10 months. Micron shares, what do you think they were, you lot out there? What do you think they were? They were $109 back in August last year. And I think I've got the year today. I've got the 1 year there. Brilliant chart. Thank you, Roger. That's amazing. And Jordan. So that they were $109 a year ago, yeah? They're now $1,051 after dropping $159 yesterday. Now, look, I know it's a great stock, and I know there's a shortage of memory chips, and I know their margins are going up, and their revenues are going to be great in the third quarter. But it's a question of evaluating whether a stock that's gone up from $109 a year ago, or even this year. I mean, let's just have a look at this year. You've got the chaps have got the year to date. It was $315 at the start of the year. It's now over $1,000. I appreciate things are really good, but how short-term is this, given the fact that memory chips are stunningly commoditized?
I think a lot of analysts love the memory chip market. They really see a runway for it. The problem now, what you're getting is that investors have piled in so aggressively, and it's not just buying one stock here or there. It is leveraged trade, 3 times, 4 times long semiconductor ETPs. So now you're getting that forced sort of buying to the upside, but you're also getting the forced selling. So what should have been maybe a blow off the top kind of market yesterday for chip stocks that have run hard wasn't simply that. It was aggressive selling because there's a lot of forced selling now coming into the mix. So that regulator yesterday apologizing, yes, there should be an apology. There should be
South Korean
managing,
regulator.
yes, but there should be managing of the situation because it is dragging some of that leverage across into US markets because of how tied these chip stocks now are in the supply chain.
Fair to say, yeah. Shares in Micron, I'll just mention it quickly. They sank Tuesday ahead of results due to the after the bell. The results are due after the bell today. Analysts polled by FactSet see earnings of $21 per share on revenue of $35.75 billion. The chipmaker hit an all-time high on Monday, having run up just a 273% rally so far this year. And that positivity returned in extended trade, though, with a small recovery. US futures look like this. Thank you, Roger. Okay, you can't make this stuff up. Nasdaq called 0.8% higher.
Ludovic Subran has joined us, CIO and Chief Economist at Allianz. Ludovic, thank you so much for joining us.
Thank you.
The story I'm just talking about here, about the leverage in the chip market, it is concerning because the backdrop of interest rates also matters here. Investors are already nervous about whether a capex cycle looks too extended around AI because of what may be forthcoming on interest rates. But, as we've kicked off this week, it looked like we may have over-egged it. We've got the ships moving through the Strait of Hormuz. Maybe central banks have a bit more time. Then we get shocked again. Bank of America now saying 3 rate hikes this year. So what is it? Are we looking at a benign landscape on credit conditions, or are we looking at something more severe that central banks are going to respond to this year?
It's a very interesting moment, right? Because this tech sell-off has nothing to do with the backdrop, I would say the macro backdrop. I don't think the AI capex cycle is affected at all. But it's true that we are faced with something which is really weird. The markets priced peace very early on, and now we see the economy still paying the price of the war. And so what does it mean? It means it will take 4 to 5 months to normalize the energy market. It will take certainly a few quarters to normalize the profits of some of the companies that were energy intensive. And it will take over a year to normalize inflation and purchasing power losses. What does it mean for central banks? I think the ECB is the only one that didn't look through and hiked. But when you look at the Bank of England, when you look at the Fed, markets are very frothy. When you look at, especially in this country, I was looking at the wage growth numbers. They're very high. And so you would think that there is a few hikes more that should happen this year. And it's not linked to the Strait of Hormuz or the supply side shock. It's linked to this demand and this extremely incredible boom, especially led from, AI, but also the fact that people have been very good with wealth effects. I mean, because it's not only AI, all the stock markets have been performing, and this money is seen in the economy.
Yeah, that said, the services numbers that rolled across yesterday, the PMIs, were somewhat weaker. So you did see some negativity spill across there. So it's not all positive. But when it comes back to what the forecast now from Bank of America are, 3 rate hikes from the Fed this year. I mean, that is highly significant. We've come from a world where we were talking about a change at the helm of the Federal Reserve, that we've got this dovish tilt, that the politics were very much evident all around the Fed, and that we were not simply going to be talking about rate hikes. If anything, it was rate reductions or just a real lid on any increases from here. To go from that to talking from one of the major banks stateside that has significant data on the consumer, significant data on businesses, saying 3 rate hikes this year, does that worry you?
It doesn't worry me that Bank of America calls for 3 rate hikes. What it worries me is the U.S. government liabilities. The balance sheet of the U.S. government is actually over ballooned, right? 7% deficit, debt to GDP going to the roof. Corporates are doing well, households are doing not too bad, it's a K-shape, right? But the government is piling up all of this war economics, right? And so, of course, what I think Bank of America is signaling is this idea that Kevin Walsh cannot be so dovish on the rates and so hawkish on the balance sheet. It doesn't work in this economy. We've always said that the Fed cannot completely look through what the economy is saying, especially in terms of growth rate and inflation. I mean, think about inflation. It's going to be above 4% in the next couple of months for the US, right? But 3 rate hikes looks like a bit too much. But I guess it is, everybody is looking at what is the right price of the US 10-year today, and I think it looks like it is above 5%, to be honest, because it is not possible to continue to be running this economy so hot with the fiscal policy that we've seen.
I had a question lined up until your last sentence, so let's go there. You think the US 10-year is going to be around 5%?
I think there is a very high chance it goes to 5%.
You and I, we all know that if we get to 10% on the US 10-year, then that could be cataclysmic for markets.
Yeah, but look, I mean,
I mean, I'm asking you the question rather than saying it, because what I hear is that people think that 4.7, 4.8 is a tipping point.
Well, I guess it has been the tipping point for the taco trade. I mean, we've seen each and every time that the US 10-year has crossed 4.7.
Yes.
President Trump has done something to calm down markets. Yes. I think this time around, now that Hormuz is behind us, there is a lot of good things priced in. I mean, it was front-loaded. I think the next big thing is, how do you roll back this 7% deficit? What do you do? I mean, think about the trade checks. Think about the one big beautiful bill. Think about how much this market has been performing and the wealth effects in the economy. I mean, if you look at this and you see the Fed not hiking, that looks fishy to me. And so I think this is going to be the return of the bond vigilantes. I'm very worried, I would say.
I saw you and that lovely chap from Natixis chatting French in the office earlier, and I was trying to listen in. But I mean, very interesting. That I also had a conversation with Mabrouk as well. Mabrouk Chetouan from Natixis, who was on Europe Early. And he was saying, look, but if there is a real problem with the US financial system and people willing to support it, then that's it for all of us, kind of thing. So it's quite a big call saying we're going to get to 5% and that will happen, because there's a whole lot of unintended consequences there, which I can't believe the Federal Reserve, even though he wants a smaller balance sheet, will let happen.
I think it will be, I mean, look, the Fed will have to hike. And this idea that markets
hang on a second. We've got a lovely board. Britain has prepared a lovely board saying, if you've got it, Roger, the Citigroup thinks there's 50 basis points of cuts. So they think as low as 3%. Bank of America thinks as high as 4.5%. That kind of typifies what the FOMC thinking is.
The very German in me, we have one hike. We are trying to get a bit the dirty middle. I think this idea that look at how the markets have been pricing this. They've been going from hikes to cuts in no time. I think this is not sustainable. And so for me, there is really a few hikes that are not completely priced in, and that should go further. Is it 3? I don't think so. But I think there will be a bit these moments of truth, especially comes to, imagine the fall in the US with the midterm elections and what it could mean. Either President Trump loses, and then it's going to be a lot of concerns about the lame duck policy making that he's going to have to do for the next couple of years, or he wins and he doubles down on anything he's been promising to this country. And so in both cases, this is going to be very hectic. So I think the last part of the year is going to be quite something to watch, because the price of the war in the economy won't be over yet. It will still be denting people purchasing power through inflation, and it will still be about rolling back these massive deficits. And so for me, this is what markets are going to be trying to tame a bit.
Sorry, I know Karen's going to come in as well, but the Democrats didn't roll back any deficit.
No,
they didn't roll back any deficit.
Nobody
under
rolls
Obama.
back any deficit.
So let's not blame Trump for this as well.
You didn't blame Trump.
No, but I mean, as much as there's some very interesting policies that we're dissecting. The Democrats were no better when they were in power on the deficit.
Yeah. No, President Biden was particularly bad when it comes to fiscal. I don't think it's his. There is one thing that is bipartisan across the world is piling up more debt to save the day and buy social peace. Yeah, and I think this is what we're seeing across the board. I think in this country, in my country, in the U.S., this is really something that worries me. The mispricing and this idea that we can continue to pile up the liabilities on the government balance sheets. This is really about domestic imbalances. I'm very worried about the fact that the government balance sheet is piling up the liabilities, and then corporate profits are banking records, and the households are doing quite okay. This is something that doesn't work for the long run.
To the point around the growth story, it feels as though Trump is chasing the AI, the technology trade very hard, that he thinks that can translate to very quick growth. Lots of irons in the fire, and where companies have been failing, he's pushed them back into the mix. I mean, Intel is a great example of that. He was talking about quantum yesterday as well. So what does that mean for investors? If there is real upside that Trump thinks that he can get for the economy out of AI and technology, what does that mean for how we view that as a growth driver still?
Look, at corporate profits in America are at record high historical. I mean, it's something that we have ever seen. So I think for investors in the equity story of the U.S., this is something that is extremely strong. I mean, this country is leading the way into the form of renaissance. So I think you need to be long America when it comes to being exposed equity. When it comes to debt, it's very, I can say, it's a triaging function. I think about, this is a country with very loose labor market policies, and so some companies will be out of work because of the AI dividends, because they won't be able to be competitive enough, while others will take the lion's share. And I think this is a little bit what the investors will have to look at, this Darwinian type of situation between the good, bad, and the ugly of the credit market in the US when it comes to corporate. But I would say being long equity in the US today with what this country is delivering to the world is certainly something where you want to be.
And a long dollar as well, because it feels like it's spilling across from the yield story to the US exceptionalism story.
Fascinating. Yesterday I think the euro hit a low in the past 18 months. Nobody talks about it. I think we talk about it when the euro is actually very strong to the dollar. This is a very interesting. How does the market correct this situation of asymmetry? It's either the dollar is massively overvalued again, and we have a tendency to short the dollar, or this is this bond vigilantes return. So Steve, to your point, it could be a 5% 10-year, or it could be that the dollar loses another 5 to 10%. That is how it's going to correct this over-ballooning of the government balance sheet in the US. Right now, I would say it's long dollar, long US equity, and certainly, as you can see, I mean, the bond market is still behaving. And so that's the type of, for me, it's a bit the quiet before the storm, because there are a lot of discussions about how this could end up or be, again, unwinded in the next couple of years, right? That's for sure.
We'll hold on for some of that volatility then, Ludovic. Thank you very much for joining us. Ludovic Subran, CIO and Chief Economist at Allianz. Coming up on the show, Russian President Vladimir Putin floats peace talks with Ukraine once again as rising fuel shortages send shockwaves through its economy. Plus, from hold to hike, Bank of America becomes the most hawkish brokerage, forecasting as many as 3 Fed rate hikes this year. And as the race to replace Keir Starmer gets underway, we'll hear from Jim O'Neill, reportedly tapped by Andy Burnham to be his chief economic advisor. Don't miss that conversation coming up at 9:30 London time.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick, and here's the CEO of Siemens Energy, Christian Bruch.
Business leaders should not stay quiet in a world which is super complex. We sit in a privileged position, and we have to use that to ensure that society remains prosperous, stable, successful.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
The US Senate has delivered a symbolic rebuke of President Donald Trump's handling of the Iran war, voting to adopt a resolution directing the commander-in-chief to halt military action or seek authorization from Congress for it to continue. 4 Republicans joined most Democrats in voting for the measure, which will not be sent to the president's desk or become law. The chairman of the Munich Security Conference, Wolfgang Ischinger, told Rittiger he's skeptical the latest US-Iran deal will lead to a lasting peace in the region.
I believe that this deal has not eliminated some of the central challenges that the Iran question represented. What about Hezbollah in the future? What about ballistic missiles made by Iran? Where are the 450 kilograms of highly enriched uranium, et cetera, et cetera? In other words, a whole bunch of questions remains unsettled, and I believe that the result of this deal will not be one that would allow the United States to say, we've solved the problem, we're now going to focus totally on China, and we can leave the Middle East behind us. On the contrary, I think the United States will be bogged down in the Middle East, will need to be present in this region for a long time to come, especially also in order not to abandon their ally Israel.
Amid peace deal negotiations, the US and Iran remain at odds over one key issue, nuclear. US President Donald Trump reiterated Washington's claim that Iran has agreed to nuclear inspections, but Tehran says no such plans have been made, vowing to continue the existing process.
The US Secretary of State Marco Rubio, Marco Rubio, is in the UAE for the first stop in a three-nation Gulf tour, with Washington's top diplomat looking to ease regional concerns around the Memorandum of Understanding with Iran. Dan joins us with more. Dan, loving your work earlier on the show and just talking about kind of gas prices and all that kind of stuff as well. But in terms of what is going on in the region, they're going to take a lot of reassurance that actually there is longevity to any plans.
Well, that's exactly right, Steve. I think on the surface we can say Marco Rubio's visit to the region is being welcomed on the ground here, though. At least there is some US representation here, and perhaps this is more of a listening tour, as the Secretary of State alluded to earlier, rather than really the US trying to put the hard sell on Arab and Gulf leaders here on the machinations of this Iran-US MOU. What we see right now, though, is oil prices falling this morning. Brent crude down now around $76 a barrel. US crude also lower as well. We're seeing fears of a supply shock starting to ease and ships slowly returning to the Strait of Hormuz as well. No doubt that's one thing that the Secretary of State Marco Rubio will be talking about here as well. He arrived in Abu Dhabi Tuesday evening. He's on to Kuwait and Bahrain now. His first message from Abu Dhabi was really a warning to Iran and a strong pushback on any suggestion that it could charge ships to cross through the strait. Listen to this.
It's an international waterway. No country is allowed to charge tolls or fees on an international waterway. That's existing international law. That's the way it is in international waterways all over the world, and that's the way we expect it'll be here. So I don't think we have anybody to convince around here in that regard. I think all the countries in this region would agree with us.
Secretary Rubio there. And of course, the positive news for the market is that there is some progress on the water. The UN's Maritime Agency saying today it's going to start evacuating the more than 11,000 sailors still stranded by the blockade, working with Iran, Oman and the United States. Traffic also returning as well, and there were some interesting figures coming out from Kepler, which counted 39 ships through the strait on Monday. That is the busiest since the war began. There's also new analysis from Allianz that says there are about 1,150 vessels currently stranded and waiting to pass through. It says they're carrying an estimated $125 billion in cargo. The insurer also saying today, even if the US and Iran agreement holds and the strait reopens, traffic isn't probably going to return to its pre-war level of about 140 vessels a day until the international community provides some kind of solid assurance of safe passage. And of course, with oil prices falling as well, President Trump has a new target, as we've been discussing this morning. It's the oil companies himself. And if you take a look at this post, he accused them this morning of gouging drivers for not cutting pump prices fast enough. He says he's now ordered the Justice Department to investigate. As you mentioned, I spoke earlier with Karen Young at Columbia University, who said this is basically political theater because you have taxes in the US. There's also refining lags that mean pump prices often take weeks to catch up to crude. So, of course, that's probably part of the reason we haven't seen gas prices coming down as far as oil prices have. And there is traditionally that gap between the two. At the same time as well, the president looking for perhaps a quick political dividend here coming into the midterms as we see gas prices continuing to pull back stateside off the back of what have been oil prices now well off their wartime highs. Back over to you.
Yes, Dan, but also, and the president knows markets and he knows your market better than I will perhaps as well. But the fact of the matter is, yes, gasoline, diesel prices are still dramatically higher than they were and dramatically lower than the war peak. But there's no doubt about it, before the drumbeat of war began, prices in WTI, which is the US benchmark, and I'm taking the most traded contract here as well, were trading at $56 a barrel. They are currently trading just south of $73 a barrel. So there is still a dramatic way down for the underlying crude price. Plus, you factor in all those other points you made about refining and taxes and lag as well. So the president knows this as well. So distracting from perhaps some of the domestic woes on inflation?
Yeah, perhaps, Steve. And interesting that Karen Young called this political theatre as well, because, of course, just on the mechanics themselves, there is often a gap between the price of crude and the price of the products that underpin it. But at the same time as well, of course, what happens next here with regards to the oil price outlook is still relatively unknown. There is still probably a political risk premium embedded in the price right now. However, analysts that we've been speaking to have also said that oil is looking pretty oversold in this environment as well. So I think we'll have to speak to some experts about what the fair price of a barrel of oil should be right now. The market says at 76 for Brent, 72 for WTI, but with inventories this low and with the political concerns still running high in the region, lots of concern about the direction of this US-Iran MOU and what can actually be negotiated, then maybe oil prices should be trading a lot higher. Then you, of course, have to balance that against the White House view as well, which says that oil should be much lower. So again, it's anyone's guess about exactly where oil should be trading here. Right now, the market says it's this, the president says it's one thing, and of course the analysts and experts who are counting the barrels say it should be another.
Tell you what, I've got a treat. I'm not going to tell the viewers everything, but I've got a treat of a guest that we've been working on that we're going to bring to Squawk Box this week as well, who is representing a very, very large American oil company. How about that? There's a bit of a teaser for our viewers, so we'll get that person on set in the next 24 hours. Karen.
Let's push on. Tech maker KNDS has announced plans to IPO on the Paris and Frankfurt stock exchanges. The company is set to offer up to 20% of its share capital. This after it agreed on a framework with the German and French governments at the beginning of the week that each would take a 40% stake. UK Prime Minister Sir Keir Starmer is looking to push through his defence funding plan before he leaves Downing Street, setting the scene for a potential policy clash with likely successor Andy Burnham. According to Downing Street, the plan will be published before the NATO summit early next month. Burnham, however, reportedly wants to review the plan, which could delay approval.
Darren Jones, a key ally to the UK Prime Minister Keir Starmer, said he will not run for the Labour leadership. Speaking to Sky News, Starmer's chief secretary said Andy Burnham will be the next Prime Minister. And we're going to hear from the former Treasury Minister and GSAM chair, Jim O'Neill, Baron O'Neill of Gatley, no less, reportedly tapped by Andy Burnham to be his chief economic advisor. We'll do that at 9:30 London time.